Okay, welcome everybody to episode 113. So very appreciative of you all showing up here. I do have to apologize, of course. It's been a little while, but I think I had a pretty decent excuse. I wasn't just being lazy. This was actually me over the last couple of months. I broke a tooth, kind of no big deal, but I actually had to scramble around, go back to Canada basically last minute, try to find a dentist that I hadn't seen in 15 years and fit me in to fit this thing. So I originally thought it was going to be as simple as just doing a crown, do an implant, do a crown. But it turns out it was actually quite a bit more complicated than that because it broke so close to the base that there was nothing to work with. And I guess the shape of my gums, coupled with the fact that I grind my teeth at night, an implant wasn't going to work either. So he actually had to do 6 visits total to fix this. I mean, the root canal was the easy part. That after that, he actually had to use the tooth next to it. So I know it looks like one single crown, and he actually did do a really, really good job. $12,000 later, but he did a good job, but it's actually 2 teeth, or it's 1 crown, but it looks like 2. But he had to actually go in there and shave down the bone to use that as well. So I can feel it with my tongue. The tooth is extremely long on the back of my mouth, but it works from the front. It looks completely fine. And here we are, we're back. So it was kind of a nightmare, to be honest. I thought it would be a quick visit, and it turned out to be over a month of dental surgery. So, word to the wise, if you are going to break a tooth, and I know we can't choose the time, but break it with a little bit of base left so you can actually fix it easier. That's my tip from me to you. But today we are going to be doing 2 segments, try to do something that would be more general to everybody interested. So the first one, we're going to actually narrow down the entire volatility complex, all of the ETFs out there that you've heard of, and I'm going to try to give you my recommendations on which of the few, because there aren't many, which of the few you should be using. That's both ETFs and also for options trading. Second subject, we're going to talk about gold. Of course, it's doing very well this year, but it's scaring a lot of people. When things go parabolic like that, you kind of wonder, well, is it too dangerous to hold? Should we just ditch gold? So I'm going to talk about that. And then, of course, the open Q&A. I've been off a little bit while, so I'm sure people have some questions. You can start getting those in the chat now. And after I do these 2 segments, we'll answer all of your questions. So another thing really quick is if I could ask this, because I've taken some time off of YouTube, it would be fantastic if everybody watching this live stream could give the video a like for me. It's going to let YouTube know that I'm back. Start pushing the content out. I'm sure for the next few weeks, I'm going to be completely invisible to the algorithm, but it would be nice if we could accelerate that. So however many people are watching, make sure you hit that like button. It's totally free. My live streams are free. Don't super chat. I don't do any advertising. It is just us hanging out, talking about volatility. So let's get to the first segment. Here we're looking at what we call the VIX futures term structure. Now, of course, you can get this live anytime you want. You just go to vixcentral.com and you can see the up-to-date term structure. But with respect to volatility traders, this thing is everything because, of course, the volatility ETFs themselves, they don't derive their price based on supply and demand like a stock or an ETF does. They actually track underlying indexes with a methodology of rolling VIX futures. So this futures term structure is everything for the pricing. And what we're going to do first is I'm going to put all of the current ETFs on the market into this structure so you can see where they all land. And then afterwards, like I said, I'm actually going to narrow it down and tell you which ones you should focus on because some of these are far better than others. And of course, we have to start with the original gangster of the volatility ETP space, the VXX. It's the longest running. It was the first one, launched in January 2009. Now, the VIXY is materially identical to the VXX. It's just VXX is an ETN, VIXY is an ETF, but the price is basically exactly the same, and they track the exact same underlying methodology and the same VIX futures. So those ones go here, and a long-term chart looks like this. Now, when people look at this chart, this is why every single trader needs to focus on the volatility markets. I know there's many ways to invest. Some people are buy and hold. Some people only buy stocks or ETFs. Some people might trade bonds a little bit. Maybe they're day traders. They swing trade, zero DTE stuff, Forex, crypto. There's many ways to invest. But when you see a chart that looks like this, it should pique your attention. There's definitely opportunity here for people who understand what they're looking at and then know how to trade them. So that's where the VXX and the VIXY lands. The next one is going to be the UVXY. I'm sure you've probably heard of this one as well. This is basically the same as the VXX. It's just 1.5 times leverage. And so given that it's the same, it kind of looks the same, it's just a little bit more diabolical. This thing was simulated prices back to March 26, 2004. That's the launch of VIX Futures, so we can actually calculate it going backwards. Remember, it launched in 2011. But going back to the beginning, it has gone from $320 billion down to single digits. Again, this should pique your attention. And then above that one, we've got an even worse one. This is the 2 times UVIX. Now, the UVIX is a fairly new product. It actually launched in 2022, and it is slightly different in that it uses a different underlying index. The UVXY and the VXX, they use what's called the SPVIX STR index. This one, the UVIX, uses the long vol index. They're very similar, but, with a few minor differences here and there. But again, the UVIX can be calculated to the beginning of the index, so going all the way back to 2005, and now we're talking about trillions down to single digits. So that one sits right there. Next, we've got to add what we would call the inverse or the short ETPs. The first one is the SVXY. It's a personal favorite of mine, but I'll get into that in a couple minutes when I make my recommendations. But of course, because it's an inverse product, now it looks like it's actually going up in price. And it has. It goes up 13.82% annualized. Very big drawdowns. So of course, if you are a volatility trader, the whole game is reducing those drawdowns. But the SVXY is a really great product. It's half leverage, so you can't get into too much trouble. But of course, if you can cut down on some of those drawdowns and reduce that a little bit, the rate of return can easily be, high teens, low 20%. It's definitely good enough. For those few of you that you feel it's not, there is also a -1 times inverse product, the SVIX. Now that's kind of a similar shape, but as you notice here, the drawdowns are much larger. So in order to use this, of course, you really have to know what you're doing. And also, if you're paying attention, you can see the annual rate of return at 10%. That's actually lower than the SVXY. Some people might think because the SVIX is double the leverage factor, if this is a short vol ETF, it should make roughly double the rate of return, right? But that's actually not what happens. Because the drawdowns on SVIX in the red here are so insane, SVIX is basically twice as strong as SVXY, but it doesn't do as well long term. This is, of course, the old thing that I always say, losses are more costly to a fund than gains are beneficial. When you're talking about SVIX having 90+% drawdowns, you're getting into somewhere where it just takes an insane amount of time to recover from those drawdowns. So don't just assume that just because something has leverage, it's better. It's probably, in this case, definitely not. But that's where that one goes. Now we've got an interesting product that is basically brand new. It's called VYLD. Now for this one, this is episode 105, so about 8 live streams ago when this thing launched back in April 2025. I actually did a full breakdown. You can learn everything about it. It is very interesting, but unfortunately, performance-wise, it is kind of a miss. You can watch the full live stream for details, but essentially what's going on here, instead of all the other volatility products calculating based on percentage moves of the VIX futures, this one, the VYLD, is using the point moves. Now, it is an interesting take on the volatility ETF structure, but unfortunately using points rather than percent, it actually moves pretty slowly. So it is true that it reduces the drawdowns 46% versus, say, the SVXY in the 70s and the SVIX in the 90s. That part of it is fine, but the performance is just too low to find a meaningful use for this in a portfolio. So now we have to talk about the midterm products, right? So these are the front month VIX futures products. These move faster. And then the midterm products, these are going to be more stable and they're going to move slower. And essentially the reason for that is because the shape of the term structure flattens out on the far end. So when you're measuring the differences between the VIX futures, the difference between M2 and M1 is always going to be a steeper line than, say, out here. So we can say that the midterm products actually move a little bit more stable. Now again, I've listed 2 here. VXZ is an ETN and VIXM is an ETF, but these are materially identical, so we can talk about them together. And here's the performance of VXZ. Again, this is going back to inception. This is a long volatility product, so it is going to act as an insurance product, which means it is going to decay long term. It's designed that way. But you can see this one doesn't have nearly the drawdown or the terrible rate of return. I actually like this because you can't really get your face ripped off if you get the timing wrong in your system, which is always going to happen to traders. Everybody dreams of the situation where they're going to call it perfectly and they're going to make millions of dollars, but the truth is you're probably going to get the timing wrong from time to time. And when you use something slower moving like the VXY, it's less punishing. But don't let that make you think that there isn't potential for return here. This is during the 2008 financial crisis. You can see there's plenty of opportunity for profit here. S&P 500 down 56%. Pretty much all of the investing world is crying their eyes out, losing a fortune. And the VXY here is doing really well. You can actually more than double your money if you get it right. So this is a really great product. Don't overlook it just because it's a little bit watered down. Next, we're going to look at another midterm product, but now on the short side. This is ZVol. Now, I'm going to gloss over this one pretty quickly because basically it's seen several iterations over the years. It launched and it was called ZIV, and it was actually a really good product from about 2011 until 2018. But right around 2018, it stopped being as useful as it was in the past. The volume was low. It wasn't very popular. It was delisted. Then it was called ZIVB. That one was delisted. Then it came back in this new form called ZVol. But again, this one is low volume still. I just think people are not on board with this midterm short vol product. Massive drawdown, of course. So really, we can kind of just skip this one. The next really interesting one, I guess interesting from the audience perspective, is SVol. This one gets a ton of attention, and in fact, it is the second largest volatility ETP on the market. Last I checked, it had $750 million of assets under management. It's a huge product. Unfortunately for SVol, and anybody who follows my work, you've seen me talk about it in videos and live streams many, many times. SVol is another one of those products that sounds interesting, but it's in no man's land. It's not good for anybody. So we can see on the one hand, it does reduce the drawdown significantly. This is because it is a majorly watered down product. Remember, the SVXY is a minus 0.5, SVIX is minus 1. SVol, while it doesn't have a set methodology that we can nail down, it's probably around 0.3, 0.25, kind of in that range. So it can significantly reduce the drawdowns. Now, on the flip side, that also significantly reduces the upside. And herein lies the problem. Who is this product for, right? Because if you think about it, if you understand how to trade volatility products, you're really just trying to reduce the drawdown so you can boost the rate of return significantly. If you know how to do that already, then you would not be interested in the SVol product that makes a very low rate of return, right? If you're a good volatility trader, you're never going to use SVol. But on the flip side, if you're not, maybe you're a beginner, you don't really understand how they work, you're going to be more the buy and hold type. Well, unfortunately for SVol, even a simple S&P 500, the SPY ETF, outperforms it on both a rate of return and lower drawdowns measure. So again, I ask the question, who is this for? It's not for people who understand volatility trading, and it's also not for people who are going to buy and hold. There's plenty of other better choices there. So it's in no man's land with $750 million of assets under management. I don't mean to be offensive to the people who built it. I'm sure they're proud of it. They know what they're doing. But I'm a little surprised it has more than $1. If you just look at it on a chart, there are plenty of other choices that are better. But that's where we land. We've got all of these on the long volatility side, both the faster moving ones with different leverage factors, and then the slower moving ones over here. And then the inverse products, we've got all of those sitting here. Again, front term products here. SVol is also what we would say a front month product. It has a hedging component and whatnot, and it does give dividends, but it's basically over here. And then we've got the midterm product there. So that is our full volatility landscape. Now, like I said, I actually want to narrow this down and be somewhat useful for you because a lot of these, you're not going to want to trade them anyway, and people are probably confused, like which ones should I focus on? So like I said, we're going to break this down for both people who are buying and selling the ETFs directly, and then I'm also going to do the same thing for people who are only option trading. So first of all, for people who are buying and selling the ETPs directly. So the first thing that I want to do is I'm going to remove the ZVol. Like I said, incredibly low volume, very unpopular, but also not a good performer anyway. So we're going to remove that. SVOL, we're going to remove as well. I know that's going to make some people sad. There's obviously lots of people who like SVOL. But given what I said, that if you do know how to reduce drawdowns in your trading, then SVOL is a worthless product. And if you don't know how to reduce drawdowns and you are just going to buy and hold, then it's going to be outperformed by any number of other assets anyway. Next, we're going to remove the VYLD. And again, that one kind of makes me sad because it is on the right track. I like new products that are actually different. And that one, I would say, got close, but not quite useful enough to use. It's just too bad they didn't have some mechanism where in low volatility environments, it would double its leverage factor or something like that. So close, but not quite, we'll remove VYLD. Now we've got this landscape. Now, the next one I'm going to remove is probably going to make some people sad again, because I'm going to remove the 1.5 times UVXY. The reason I'm going to remove that one is it's just too difficult to time something like that. Like I said, I know people have this dream that they're going to buy it at the absolute low and it's going to spike up and they're going to make a ton of money. But in real world trading, that's probably not going to happen. And the fact that it's a leveraged product, you're going to be bleeding capital way too quickly while you're waiting for the market to crash. It's just not going to lead to a rate of return that you want. Now, I'm going to remove the 2 times UVIX as well, but I will say if you're using it for purely short-term hedging purposes, then maybe it still has a use. It is a very fast-moving convex product that if you get it right, it can actually protect a portfolio. But we're volatility traders, that's not how we use it. So I'm going to remove the UVIX. Next, I'm going to go a step further, and I'm going to say that even these ones, even just the 1 times vanilla VXX, if you get the timing wrong, you could end up bleeding 40 or 50% of your capital waiting for the market to crash. It's just too punishing to get the timing wrong. So that's only going to lead to these ones, unfortunately. These ones are watered down. Like I said, the midterm products are flatter. You can hold them for longer and you can be wrong for longer, kind of waiting for that event that you think is going to be happening. So we're going to leave those ones there. As far as these two, I'm also going to remove the -1 times SVIX. And the reason that I'm going to do that, like I said, SVXY just on its face, buy and hold is better, but also it's going to take you a little while to learn how to reduce those drawdowns, right? It's not always so easy to do that. People think, oh, well, you just sell it there. You just sell it there before it crashes. Well, it's not as simple as that. So what I would say is we're going to stick with only the SVXY for a while, but if you can trade for 2 or 3 years and you've proved to yourself through different market environments that you can actually manage the risk, then perhaps I would say, okay, with a proven track record, maybe you can start increasing your leverage factor. But as far as buying and selling, that's really all we've got, and it's not going to come as any major surprise here. Our main flagship tactical volatility strategy, these are the ones that we use. It might sound like I'm talking my book here, but actually the rationale behind leaving only these ones is pretty sound. If you want to make money, you're going to stick to shorting volatility with SVXY, and you're going to go long volatility only in the most extreme circumstances, and you're going to use a midterm product to do that. Trust me, you can make plenty of money, and more importantly, you can manage the drawdowns. When you get into that 40%, obviously 50%, people are going to pull the plug. There's no chance that they can hang on for that. So we're going to stay with SVXY and either one of these. VXZ is an ETN, VIXM is the ETF. Regulatory-wise, there may be one or the other that you can use. Okay, what about options trading? Well, for this one, volume is going to matter. So we're going to go in here and we're going to start, of course, with VXX. And when you're checking options trading volume, one of the things you can do is just go to a monthly cycle, just open that, go down to the money, and just eyeball the open interest, right? Are there enough contracts being traded? Would this be efficient at all? So the VXX, that's going to be just fine. The UVXY, we can go to this one as well, and it's also good enough, right? VXX and UVXY, these are very liquid products. You're never going to have a problem with execution. UVIX, surprisingly, actually not terrible, right? Not quite as good as the other ones, but pretty decent here as well. If we go to the inverse products, the short ones, SVXY is a little bit low. Now, technically, you could do it, but the thing you have to remember about options trading is the options market is very efficient, right? You're competing against people who really do know what they're doing, institutions, full-time traders. This typically isn't the tourist type of trader that's trading not only options, but options on vol ETPs. The people who are trading in this space are typically quite knowledgeable. So in that case, given that it's an efficient market, we don't care whether it's long or short, right? There is, of course, puts and calls to take care of that. So all we're looking for is liquidity. You could trade SVXY, but VXX is more liquid. Same thing kind of applies to SVIX. It's not that you couldn't do it. At certain strikes, it's going to be just fine. But again, VXX, UVXY, far better. So we're going to eliminate that. VYLD doesn't have options. SVOL does, but I don't know why anybody would do that. Of course, volume is very low and the other ones are better. ZVOL doesn't have options, so we can eliminate that one. And then VXZ, this is the long volatility product, the midterm product, very low volume. So when we go back to our page here, of course, we're going to eliminate ZVOL because it doesn't have options. We're going to eliminate VYLD because it doesn't have options. We're going to eliminate SVOL because the volume is very low. We're going to eliminate these products because the volume is very low. We're going to eliminate both of these inverse products, even though, like I showed, they are decent. You could trade them. But options has puts and calls. You can do everything with either of those ETFs. So given that these are better, yeah, why would we need those either? Now, we are really only left with these. Now, I'm going to eliminate VIXY. No real reason to do that. VXX is the most liquid one. So we've got 3 left. Now, I'm going to leave all 3 here. If you're an options trader, you can trade any of these 3. Now, for me personally, I tend to run about 4 or 5 different volatility strategies, and I don't like to use the same ETF over and over again in different strategies. Sometimes, you can get your signals crossed with the expiration cycles, the strikes you're using. It is a good idea to mix it up, so it is nice that we've got 3 different ones to use. But in order, I would say you're going to probably default to either VXX or UVXY. They're both kind of the same. They're both very liquid. You can choose either one of those. Remember, again, for the options world, it doesn't matter the leverage factor. When you're trading the ETFs, it very much does matter the leverage factor. That's pretty much the main feature that you're looking for. But with the options world, given that everything is efficiently priced, it's just going to mean that the strike is a little bit further away. But it doesn't really matter that it's 1 to 1.5. So you can definitely use the UVXY if you want. So I'd go 1, 2, and then 3. If you happen to trade a whole bunch of strategies and you want to put something else in the UVIX, you can do that. But for option traders, we've eliminated the entire landscape down to just 3 most liquid products, and you can do everything you need to do in the volatility space with just these products. If you're an ETF trader, then of course the leverage factor comes into play. You've got to be very careful about those drawdowns. And in this case, we're going to use the watered down SVXY and the midterm product long vol VXC. Again, my personal favorites. I've made a fantastic rate of return over many, many years with just those products. So there you go. We've taken a very complicated volatility ETP landscape with ETFs all over the place that all kind of do different things, and we've narrowed it down to just a few of the best choices for you. So if you're, studying and you're trying to learn how to do this stuff, that's where I would start. Like I said, if you get really good at it on your own and you've got a fantastic track record, at that point you can start looking to layer in more rate of return by getting some of the faster moving products. But until you fully understand everything, I would stick to the ones I recommended. And one more thing I will mention, I do actually have a full free volatility ETF course that I'm building. Now, of course, if you're a VTS member, it is in your library. So you would go here, you'd go to my library, and all of the courses at VTS, these are for members, but all of these courses being available, you're going to want to do this one here, the Volatility ETP Landscape course. There's currently 11. I've got titles set up that there's going to be about 30, right? Eventually, I'm going to start doing the individual ones. What is VXX? What is SVOL? But you can get it here, but you can also just get it on the website. So if you go to my YouTube channel, go to videos. My most recent video, I definitely want you to watch this one.
If the stock market
Let's pause that guy yapping. I want you to watch this video, of course, but in the description for the video, I've actually linked the entire course, all the parts so far. So you can actually go learn about volatility ETPs totally free. You don't even have to subscribe to VTS to get that. But there you go. That's your landscape. Now you've got your marching orders. You can go study just the ETFs that are actually the best ones. So now let's move on to topic number 2. Okay, so of course we have to talk about gold. The price has gone parabolic On the one hand, if you've held gold, then you're probably really excited. On the other hand, it's freaking a few people out. So we can look at a chart here. I always use the IAU. The GLD is materially identical, but IAU has data going back a little bit further. And we can see, of course, this is what freaks people out. It's so high that everybody's saying, oh, it's over, don't hold it, you're going to lose all your money, whatever people are saying. But from our perspective, of course, we are tactical traders, so we don't actually have to look at the buy and hold performance. What we want to look at is how is gold expected to perform at the times that we are going to hold it. So right here, I'm going to, of course, hint a little bit to how I personally use gold in my portfolio. I have basically for 20 years, and I still will, despite that rocketing price higher. I will still use it, but I also want to give a little bit of an indication of how people can tactically use gold, because there's actually a lot of meat on that bone, even if you're not a buy and hold investor. So the first thing that I want to do really quickly, this is going to be important for this next 10-minute discussion. It has to do with me mining volatility data to separate the market into investable ranges. And then what we do in those ranges is how I've made the killer rate of return for the last 15 years. My VTS Volatility Barometer is a composition of more than a dozen volatility metrics that combine to be the best representation of overall market volatility that you'll find anywhere. Essentially, I'm data mining volatility metrics to tell me when to hold those aggressive market positions, when to protect my capital and move to safety, and when to flip that switch and actually try to capitalize on a market crash. For example, we'll definitely be shorting volatility during stable markets. That's when the trade performs the best. But as volatility rises, that's no longer the case, and we have to shift into a safety position like gold. And then in extreme volatility, we can actually take advantage of the market crashing and profit from allocating to long volatility. The point is, through effective volatility targeting, we can make sure that we are only holding the asset classes that perform best at that time. So yes, volatility targeting is what I'm going to be talking about today. And the very first thing here, I've got the S&P 500, the SPY ETF, buy and hold, and then I've got the IAU Gold ETF, buy and hold. Now, one thing right out of the gates that might actually surprise some of you, this chart is measuring all the way back to the inception, the launch date of VIX futures. Given that I am a volatility trader, that's a very important date. A lot of my data goes back to March 26, 2004. So that's what I've done with this chart. And you can see, surprisingly, gold has actually outperformed the stock market over the last 20 plus years. Not only is the rate of return slightly higher, but the drawdown is also lower as well. So you could make a case that gold is actually a better asset than the stock market, which is crazy. Nobody ever talks about that. Now, obviously, you can see in this chart, they achieved that rate of return in very different ways. They both don't do well and do poorly in the same market environment. That's what we're going to try to narrow down today. We're going to try to figure that out. So what I've done is I'm trying to divide the market basically in half, the 50th percentile line. On the upper end, we're going to isolate just the bull markets, the most stable periods when volatility is low, when you would expect the stock market is doing really well. Now, just really quickly, I'm using what I call the adjusted M1, M2 VIX futures. If we go to my email, this is what our daily emails look like. All the trade signals are up here. I usually have some type of blog article. But down here, we've got a volatility dashboard. And in the dashboard, I actually show the adjusted M1, M2 VIX futures. I show the standard ones as well, but the adjusted futures are basically, this is the VIX futures term structure here. The adjusted, you can see this one expires in 18 days. This one expires in 46 days. Adjusted just means I'm calculating the number of days left to expiration and using a smoothed out value. If you just use M1, M2 VIX futures, you get some real wonky numbers around expiration. So I use the adjusted. But anyway, 50% of the most bullish signals in the market. And this shouldn't come as a major surprise, but we can see the S&P 500 is significantly better. Not only is the rate of return better, but the drawdown is significantly lower. Like I said, stocks and gold got the same 20-year results, but they got them in very different ways. The S&P 500 is clearly a better asset class for stable markets. And now we can look at the lower levels. These are when contango is very low, basically bearish markets. And this also includes all of the major market crashes as well. And now we can see here it is flipped. Gold is the good performer, much more consistent over time, higher rate of return, much lower drawdown. Gold does better in bad markets. This gets to the heart of volatility targeting. Why would a person just buy and hold an asset class when you know it is a guarantee that it's going to underperform in certain markets, right? Take the S&P 500, for example. There's nothing wrong with holding stocks, right? 50, 60, even 65% of the time, they do fine. The problem is we know with certainty that they're going to have bad periods, and we know when those bad periods are. When volatility is elevated, I can promise you the stock market is not going to do well. You're never going to come back and say, oh, look at that, the VIX is at 40 and the stock market's doing great. No, it's not. It doesn't work that way. So why would somebody not focus on this volatility targeting? I don't know. But to answer the first question, what would happen if you combined the two? What would happen if you used the stock market during the best periods and then you used gold during the worst periods? Would that improve the results? And the answer, of course, yes. The green line is the combo. 50% of the highest contango readings, you're holding the SPY, and the bottom 50%, you're holding gold. Now we can see the rate of return is higher than both of them, and the drawdowns are lower as well. This is something that you could actually, if you squint and you kind of ignore a few low-hanging fruit obvious things, there are investors who could do that. Make 12.4%, have a 36% drawdown. You could kind of run with that. Whereas buy and hold with gold, a 45% drawdown is too high, and stocks at 55 is way too high. This is why it drives me crazy. You go on Twitter and you see all these asset managers telling people to buy and hold. Oh, just buy and hold. You can't beat the market anyway. Just hold on to it and, whatever. Yeah, that's easy to say during a bull market, but as soon as the drawdowns get to that insane level, once you get into the 40s and absolutely when you're in the 50s, people are going to pull the plug. They're going to screw everything up. I've been trading for 20 years. I remember after the financial crisis, there were a lot of people that when it crashed 56%, a lot of people exited the market, and it wasn't until 2013, 2014 that they started to come back. Psychologically, drawdowns this large are a total non-starter. But of course, 36, it's not saying it's going to be fun, but it's kind of in the realm of manageable. So this is a very basic tactical rotation strategy that you could employ if you had to. Now, of course, I don't have to. At VTS, we take it far further than that, many, many steps along the way. Yes, I do use gold, IAU, but within the same strategy, I use short volatility because I know gold doesn't do well in stable markets. Why in the world would I buy and hold gold when I know that short vol is going to do way better during low volatility? It doesn't make any sense. And I've also cut off the top here. I know that gold can struggle during an extreme market crash as well, and clearly long volatility is the better position. I'm not going to handcuff myself to hanging on to something when I know it's not going to do well. Defensive rotation, the same. 2 times Nasdaq, fantastic performer. It's crushing it for us. But I also know with certainty that when volatility rises, the 2 times Nasdaq is not where I want my money to be. So we use utilities, we use cash. This strategy's crushing it because I don't just buy and hold. I know what performs best in those ranges. And again, same thing here. Like I said, the S&P 500, nothing wrong with stocks 60% of the time. But obviously we have to cycle out into safety, and the CAOS ETF is really good for tail risk. If you had to do it, I guess you could do this, but of course there are better ways. And when you put it all together, there is an obvious payoff. But if we just focus specifically on gold, this is also what I'm talking about. So within the tactical volatility strategy, we only hold gold about 37% of the time. That's happening when volatility is elevated. It's too risky to be in aggressive positions. We cycle out into safety, and you can see this is the time when the stock market is not doing well. This is the time when short volatility is having big drawdowns, and our gold positions are doing well. So like I said, it might freak people out that gold did so well here. It also did insanely well in 2018 to 2020. It did extremely well early on before the financial crisis. There are times when gold does extremely well, and it worries people. But for me personally, I know I'm only holding it during its best market period. At the times when no matter what the price is, I can expect that it is still going to behave as a safety position. Obviously, sometimes it does better than others, but it is a safety position for me. For a buy and hold investor, would I be comfortable putting money in here and waiting 10 years? Probably not, right? It's up 50% this year alone. I would say it's probably not the smartest idea to dump all your money in gold today. Hopefully nobody's actually considering doing that. But for me personally, and this one is just going back to 2018 now, The reason it's at 2018 is basically because I was just showing the difference between GLD and GLDM. M is just the mini gold. Not surprising, it's an ETF. They're packaged very well. It's basically the same performance when you include all the fees. But anyway, you can see in the last few years, in the last 7 years, for our strategy, gold is up almost 10%. And we're only holding it 37% of the time. So that's actually a really, really good performer for us. Gold itself is a safety position that makes money for us. So there it is. My opinion is basically that if you were just absolutely handcuffed and you had to buy and hold gold, would now be a good time to dump your money? Probably not, right? I don't think that I'm saying anything revolutionary here by saying that. But for me personally, as I've just shown, tactical investing is the best way to invest. Right? Of course, I would like people to subscribe to my community to learn how that we do that personally. But I just showed you how you could start doing this on your own. You could go down the rabbit hole, and sure, it's going to take you several years to get to where we are in our community, but you could do this. Tactical investing is just basically the acceptance that why would I hold something when I know it is a certainty to underperform? Right? I mean, if anybody can come up with the answer to that, why you would hold stocks when you know for sure it's going to do poorly, given what the market volatility is telling you, can you think of any reason why somebody would continue doing it? Laziness, maybe? They're like, I just can't be bothered. I don't know, maybe, but I'm not that type of investor, and I hope you aren't either. So we'll get to the live Q&A in just a second here, but I launched VTS all the way back in January 2012 with two main goals. First, to crush the financial industry and help investors start making real progress towards their retirement goals. And secondly, to provide that outperformance at a much lower cost. A low monthly subscription fee scales far better than paying a traditional percentage of assets. Our portfolio is currently 3 independent strategies with low correlation to the stock market and to each other. It's also not active day trading, and trust me, anybody from any background can follow VTS in just a few minutes a day. Since retiring from pro golf in 2005, I've been an options and volatility trader for over 20 years now, and I share a lot of invaluable volatility data in every daily email to subscribers. I'm also a certified workaholic, and there's a growing list of courses that all members have full access to. There's a free trial to VTS on my website available to everybody. Come join members from over 70 countries around the world. I can definitely help you achieve your financial goals. Now let's get into the live Q&A. Okay, so hopefully you learned a few things. Hopefully it was interesting. I always like doing segments like that where we can test different things and actually show the numbers. I think that it's pretty useful for people. Of course, you don't have to do anything exactly the way that I do it, but these live streams are basically just to give people ideas and hopefully take them down a direction that they never thought of before. So if you have any questions on that specifically, I can see there's several questions here, and we will get to them. It is, as always, it's 1:40 in the morning for me here, so we will, I don't know how long we'll go for. I'll try to answer all the questions, but it's good to be back. I'm, as I mentioned, kind of in YouTube purgatory here. Taking 2 months off essentially is never a good idea. If you do manage a YouTube channel, you'll know that. So likes and whatnot would be very appreciated. I can see there's 24 likes. There's more people than that watching. So let's get those up. The plan is just a video a week, a live stream a week, do that for a couple months, and I'll basically fix the algorithm for myself. So get back into the good graces of YouTube. But let's get into some questions here. So hello to my sister. I was just back in Canada. It was nice to see the family, although it was for, not a whole lot of fun having missing teeth, but, whatever. They don't care. I looked like a hockey player. It was fine. I didn't tell people the real reason how I broke my tooth. Anyway, here's a question. Do you think, let me adjust this. It's been a while since I've live streamed, so I'm a little bit kind of all over the place. Let me center this so I can see it. How about that? I don't know. Looks good. Okay. Do you think pairing SVXY with VXZ 50-50 and rebalancing makes sense? Interesting. So, a couple of things here. First of all, SVXY is a front 2-month product, right? And it's 0.5 times leverage. VXZ is a midterm product at 1 times leverage, but the midterm futures move slower. So it's not exactly the same. The front month and midterms, they kind of shift around based on market environment. There's no long-term rules or, ratios that we can stick to. But generally speaking, these are quite similar and they are opposite. So you are essentially taking opposite positions in the same strategy at a 50-50 allocation. So I would not expect there to be very much profit there. I would have to run the numbers because you got to take a few things into account here. Number one, the convexity of each of those trades changes at different times. So for example, what I mean is VXZ, it's a slow bleed during stable markets, but then when it actually takes off and goes, when the market crashes, it kind of accelerates and you can get more bang for your buck than you've been losing all along. So that is kind of sounds okay. But then the same is true on the flip side. You've got SVXY that if it's doing well with the market, it's going to be making some money for you. But when things go south, it can go extremely quickly. And I suspect the SVXY damage that is done during a drawdown is not offset by the VXZ that you are holding. So my guess is this is not good. I don't know. I mean, you didn't say specifically. I don't know. I would assume that you're talking about long both of them, right? I guess I should have probably clarified that. But yes, that's the first problem, is that you'll never really be able to get a stable ratio of expectations. And the second problem is you're going to be tying up capital, a lot of capital, to do this. And I don't imagine, even if there is profit there, I don't imagine it would be very impressive. There's plenty better ways to allocate your capital than this. So without testing and running the numbers, let's just say it would probably still be positive, because pretty much everything you do with the market is, unless you do something really stupid, it should trend upwards over time, but I don't think it would be worth the capital. Glad vacation is over. Vacation, that's a stretch, but I know from your perspective, it kind of looks that way. But yeah, I've been working. I've been doing my thing. I just wasn't looking very pretty, so YouTube was put on hold there. Glad I'm back. Thank you. Good to be back. Glad there's a few people who remembered that we actually do these. Come by, ask a few questions. I think, like I said, if I just keep going with consistency for, a couple of weeks, it should be fine. All right. Glad to see you again. Hope you had a nice time in Dubai and found a potential new neighborhood. So yeah, this probably refers to one of my last live streams I did. I live in Dubai, for anybody who doesn't know that. I'm in Taiwan now, but I'm a tax resident of Dubai. And I do Airbnbs for now because I haven't actually bought a place there. And the last time I was in Dubai, I did 6 different Airbnbs, 2 weeks in each place, trying to finalize where my favorite neighborhoods are. And the truth is, I thought I got some good answers. And then the last place I stayed at was called Dubai Creek Harbor, and it was awesome. So now I guess I've got 2 places that are there. I thought I had narrowed it down to Dubai Harbor, kind of like just next to Dubai Marina. But Dubai Creek Harbor is pretty awesome. So we'll see. My algo switched today to safety from the market. Face orange frowning. Safety from the market. Did I miss something? That's interesting. Okay. I mean, everybody's numbers and everybody's levels are obviously going to be different. I don't know. Maybe yesterday, yesterday was kind of the last 2 days we can see it's slightly down. This move here kicked my strategies into safety. This one has not yet. We're still at, comfortably within that range. So I don't know. Maybe you're set up for ultra sensitivity with your signals, which is totally fine. I mean, of course, all that matters is that it works for you, and long term you get a good rate of return. Most important is that you get out of the market before bad things happen. And it sounds to me, without knowing the details of your strategies, that you get out awfully quick. If what's happened in the last 2 days kicked you out, you are set to get out at the very first sign of trouble. Okay, I'm wondering about calendar spreads. I should make these bigger. I'm trying to, my eyes, I'm getting real old here. There we go. I don't know if people on your end can see me switching things around, but okay. Let's start again. I'm wondering about calendar spreads. Been reading up on trading forward vol structures, especially when front IV is elevated versus back IV. So calendars is, of course, something that I trade a lot as well. It's perfectly fine. Now, the thing I always remind people of whenever options questions come up is that the calendar itself is just an option structure. Like, it's not a strategy per se. It's just a structure, right? So you've got butterflies, iron condors, verticals. They're all just structures. Every one of them can be used effectively, and every one of them can cost you money. It just depends how you use them. So that's the first thing I would say, is that trading calendars themselves is just, yeah, sure, go ahead, trade calendars. There's nothing wrong with the structure of calendars. It's just, in of itself, doesn't really mean anything. But the second part about the IV, of course, with a calendar, it's really going to depend how close to expiration you take them. So your comment here about if you have elevated front month IV and you've got, lower back month volatility, when you are trading a calendar, say an earnings announcement is coming up, this is typically the case. The front month IV will elevate, or maybe there's some type of binary event coming that it'll be resolved before the back month contract expires. In that case, it would be this situation. You'd get elevated front month. And then you'd probably want to take them quite close to expiration so you can basically have that front month contract either outright expire worthless or, bring in a significant amount of that premium and then close the trade. So it can be used effectively then, but calendars can also be used effectively as more of a long vega trade where you close them out extremely early. Because early on in a calendar cycle, it's the back month volatility that's far more important, and that's the long vol position. So it's basically, it flips. Calendars can be used, shorter term to capture front month IV, or longer term to replace an iron condor, for example, and use it as a long vega trade. So totally different parameters. Again, point being, it just depends how you're going to do them. But yeah, the calendar itself is a great structure. I use them all the time. I'm not sure if I actually said anything there, but yeah, got to be mindful of the fact that the strategy is independent of the structure, right? You got to do something with it. Otherwise, it's just, slap on a butterfly, it's the same thing. Put on iron condor, it's the same thing. All right, this happened with gold option terms due to a recent drop. Gold term structure IV was in backwardation. Yeah, this is a continuation here. So just, as an example, of course, we were looking at, the gold here. Obviously, when this recent week happened, it was down 6.3% in just a single day. So this is probably going to do something to the implied volatilities. And it's going to show up in the front months far more than the back months. Probably most traders believe that it's going to be relatively short-lived. It is I didn't hit screen share. That's what happens when you haven't live streamed in a while. But yeah, so it's gone parabolic, but it did crater for the last week or so. It's actually down significantly. So that's what you're talking about. It actually bumped up the IVs. And now you're thinking of a calendar. I think it's just fine. But if you're trying to capture the front month, you do have to let those run pretty close to expiration, which means make sure that you're hedged. Make sure that you have some type of backup plan or stop losses or something, because the gamma gets pretty high close to expiration. All right. How to subscribe to the daily emails. Great question. I love questions like this. You can go to the website. This is not what I'm interested in. You can go to my website, volatilitytradingstrategies.com, and there is a subscribe tab. Now, the good thing about it is there is a free trial. So if you sign up now, you get 2-week free trial. You can see everything, and it's 100% access. It's not like a little glimpse of anything. You are just going to literally get all the signals, access to all the courses. And if it's for you, then great. You stick around and you enjoy. And if you don't, 2 weeks is plenty of time to get an idea for what you're looking at, right? It's time to dive into a few of the courses, watch some of the videos. VTS is essentially, it is just my portfolio, and I'm sharing the trade signals with a community. It's not like I'm going in there and trying to design things so it looks good for a third-party audience and then they can come in and pay me. It's not like that. 100% of my capital is invested in this way, and I share the signals that my own capital is in. So, you have to see it for 2 weeks in order to know if my style is going to match what you do. I suspect it will. If you look at the performance and you look at how easy it is, I suspect it will, but go ahead and take the free trial. Let me move this around again. Yeah, take the 2-week free trial, unsubscribe. No hard feelings if you do. All right, Luke, when you compare IAU versus SPY, I assume it does not account for the SPY dividends. It does account for SPY dividends. So let me see if I can, anyway, the SPY making, I believe it was 10.68% annualized since 2004. That does include the dividends. And of course, IAU doesn't have any. But everything that I would show is always, adjusted for dividends. It's the SPY with dividends reinvested. Looking forward to your future videos on Bitcoin and which risk measures you use versus your other strategies. That second part, I don't know how much I can share because that's kind of the secret recipe of the strategy. But yes, there's going to be more Bitcoin talk. I didn't actually want to, bombard people with it originally. Oh, look at that. It was just called up right there. But our official portfolio doesn't actually include the Bitcoin. So whenever you go on the website and you look at performance, you can go into the portfolio section and you can actually see all the numbers from the past. You can see all of this. None of that has ever included anything to do with Bitcoin. Not a single dollar made or lost is ever reflected. But of course, we do have an optional Bitcoin strategy for people because it's, for me personally, I've been a little negative on it. I held 2 Bitcoins for a really long time and, sold them and made some money. So I guess I'm happy in that respect. But I've just personally never felt, certainly in the last few years, that Bitcoin is any better than leveraged equities, leveraged Nasdaq. I just don't think it is. I think the reason that a lot of people, feel like it might be is simply because they are probably including performance going back further than a few years. If you include, you hear it all the time. You'll see people say, oh, Bitcoin's up 100% a year. Sure, if you go back to 2012, 2015, but, I personally didn't even buy it until 2022. So what do I care what Bitcoin did in 2016? It has no effect on me. I'm only interested in what it does today going forward. And for me personally, it's just my opinion. I don't think it's going to do any better. And I don't think it's going to be that uncorrelated to double or triple leverage Nasdaq. I just don't. So it's an optional strategy now, and I will start talking about it, but it's not going to be talking about it as if it's in the portfolio. I'm not sure when and if it ever will, but Bitcoin's an interesting thing. People either love it or they hate it, and my strategy has done well. By the way, I should probably mention, sorry, I'm clicking around a little bit here, but if you go into the blog section and you go to the articles, you can type in Bitcoin, and I hope something comes up here. Bitcoin breakpoint strategy. I did go through sort of a brief explanation of what it is. This is what I've been talking about, that of course the performance has been exceptional going back to 2013, but there's no doubt that just long term, obviously there is nothing in the world that can continue going up at that speed, right? It's going to level out and it's going to be pretty subpar compared to its previous levels. This isn't an opinion. This is just how the markets work. If it was making 100% a year, long term, it would break the markets. It was only doing that because very few people were holding it. And as soon as you've got institutions jumping in with all these ETFs and you've got fund managers putting allocations in their portfolio, once you start doing those things, obviously it's going to start significantly reducing. This is what I was talking about with Bitcoin versus triple Nasdaq. This is going back 4.5 years. It's basically the same thing, right? I mean, yes, if we went back further than this, it would start to decouple. But as you can see, yeah, Bitcoin is kind of a normal mainstream asset class now. Why in the world would we expect it to make 50 or 100% a year? It just won't. And but yeah, you can go through the numbers. Strategy's good. It's very similar to my other tactical rotation strategies where we have multiple positions. Just in this case, let's just make it extremely simple. This is why it's called the breakpoint strategy. It is just simply a cutoff between Bitcoin and gold, and that's it. And we're basically just trying to outperform Bitcoin. And the way that you do that, because when Bitcoin's doing well, nothing can beat it. But the way that you do that, of course, is reducing the drawdowns. So that's what the strategy focuses on. And you can learn a little bit about it here in this article, but there will be other things coming, I promise. So look forward to that. But, you know, with the caveat that I've been trading tactical rotation with short vol equities, safety positions, long volatility. I've been doing that, officially with VTS since 2012 and unofficially before that for 3 or 4 years. That's where my focus is. And I don't think Bitcoin is better than that. So it's just another strategy, so to speak. Okay, new to ETFs and VIX and VIXs. I appreciate your content. Yeah, thank you. Yes. Come back. We talk about this stuff all the time. And ask questions. Any questions you've got. I'm always here. My favorite of the strategies after being a VTS member for a while is defensive rotation. Not surprising. The performance is extremely good. I'm curious if you've ever backtested using triple leveraged in lieu of QLD. So I need to pull up a couple of things here. First of all, if you also, sorry to keep talking my book here, but it's just, this is where everything, I post so many articles. People don't know I write, but they think I do videos on YouTube, but I actually write a lot. You can look at the quilt chart here. This isn't updated now. These numbers are slightly better now because this month was up a little bit as well. But you can see the defensive, when it's doing well, of course it does very well, right? It can really be a slam dunk. Obviously 2023 was fun. But yeah, it's doing great. It's outperforming. So it's not surprising for me to hear that that's the one that you actually like. As far as the TQQ, what I want to do here is, ordinarily I would like to just answer each question, but I know that I've got a video that is quite literally exactly that question. I just can't remember which channel I put it on. Let me check the main channel. Leveraged ETFs. Yeah, it's this one here. That's a short video. I wonder if that's just a little clip. But anyway, let me try to accelerate and see if I can get to the punchline. God, this is terrible. This is terrible content. You should never do this on YouTube. Let me search the Clips channel again for leverage. Let me spell it right. Should you 3 times leverage? Okay, here we go. This has got potential. So pause that. Okay, right here. This will be good enough. So hopefully you can see this. So this is essentially what the strategy looks like using single Nasdaq, double Nasdaq, and triple Nasdaq. Now, it shouldn't come as a major surprise that as we increase the leverage factor, the results get better. But it's worth noting that there are diminishing returns involved here. You can't just, QLD is double this. It's not going to be double, and that's for a couple of reasons. One, the drawdowns are larger, which is always more punishing. So on a ratio scale, it's not going to scale upwards. And secondly, the whole strategy isn't QLD. There's also utilities, there's also cash, and of course, those are never leveraged. So the strategy should never actually end up being double. And then when you go to triple NASDAQ, you're really only eking out a smaller return, and you're significantly increasing the drawdowns. And I personally think if we're talking about a strategy as good as defensive has been for so many years, making over 30% a year, you should expect that's going to occasionally come with a drawdown. And only once it did. But 2022 at the bottom, it wasn't fun, right? The strategy was, it's a 40% drawdown. That's significant. Pretty close to the rate of return. You got to remember that the stock market makes roughly 10% long term with a 50% drawdown. That ratio is terrible. This ratio is pretty good still. But getting to 49, it's kind of like I mentioned in the other segment that I was doing. Once you get to a certain level, it doesn't matter how good the rate of return is. Investors are going to pull the plug. Everybody has a level of risk tolerance that they're just like, okay, yeah, I'm out. If you're talking about something like the Vanguard VBanks, 60-40 stocks bonds, it makes about 8 or 9% a year. And in the financial crisis, it dropped 38%. If you're going to be crashing 38% and you only have potential to make 8 or 9, obviously pull the plug. But if you're talking about the defensive rotation, 40% drawdown sounds bad, but it's up now 33% annualized. So it's kind of worth it. But once you get to 49 with using the triple TQQQ, I would say there are not that many investors that when we were in our biggest drawdown at the bottom of 2022, when it was looking, pretty ugly, there are not that many investors who would not have pulled the plug. The reason that we kept most of our community intact is because it was a diversified portfolio. The whole portfolio only drew down 26%, but there's potential to make it back. But I never want to put myself in that position. That you got to remember, on that day when the drawdown hits the bottom, you don't know if it's ever going to come back. You have to understand that psychologically, you're going to think, oh, this time is different. You can look at the chart and you can see that it went from 2012 to 2025. It's awesome. I would have just held on. Would you? Are you sure? Because at that bottom of a drawdown, it's going to feel like the end of the world. This is, again, like I mentioned, asset managers telling people to buy and hold is ludicrous. Nobody's going to buy and hold the stock market when it's down 55%. It's going to feel like it's on its way to a 70 or 80% drawdown. It's going to feel like the end of the world. The news cycles are going to be absolutely abysmal. It's going to be talked about like it's the worst crash in history. And you're not going to make rational decisions. So from my perspective, I don't put myself in that position. I don't suffer those massive drawdowns. I think the double leveraged is fine. It will come with occasionally big drawdowns, but it's totally fine because we made it back in less than a year, so it's fine. But no, triple leveraged for me personally is a no-go. Now, if you want to go rogue against my positions, remember my portfolio signals are just my capital. You want to do something different with your money? There it is. But just know that that's not going to be much fun. And you're not getting a whole lot of benefit out of it. Really, you're just, for me personally, I've said it a million times, you don't need to make 30% a year. 20% a year is just fine to make you a multimillionaire. You don't have to chase 40. You really don't. Okay, do you actually make money when you move to CAOS? That thing barely moves. Yeah, most of the time it barely moves. That's why I like it. Even on Liberation Day, when the VIX got over 60, CAOS only rose by 5%. Am I missing something? You're not missing something. It is much slower than long vol. That's an absolute fact that it doesn't move as much as long vol. But the benefit to CAOS is if you hold it for long enough during an extended crash, not only are you saving yourself capital, of course, but you are also, this is what it looks like within our strategy, right? Now, we just switched to this recently, so this is a back test. We switched to it somewhere around here, so we haven't had, right about there, we haven't had an opportunity to use it yet, but plugging it in instead of long volatility, it looks like this. But you do need a significant crash that is extended for multiple days and hopefully multiple weeks. Then you can start to see the benefit. But you got to remember that the primary focus of the CAOS ETF for me within my portfolio is to not lose money, right? Goal number one, when the market is crashing and everybody's crying because they're losing their money, goal number one is to not lose money with them. Don't join them, right? Move to safety, protect your capital. Avoiding drawdowns is the number one most important thing for all investors in the world. It is critical that you have a method to protect your capital. It is a bonus if you can actually make some money while you're doing it. So this is why the CAOS ETF, it will make a little bit, maybe a lot. If it's a full-on 2008 financial crisis, I would imagine CAOS does pretty well. Cash here, we're not going to make a thing in defensive rotation, but we are going to protect capital. That's why this strategy can throw up 33% a year, because it's only had one drawdown. Most of the time, we're in utilities and cash when the market's crashing. And of course, long volatility here. Money can be made. Big money can be made there, but we don't get an opportunity because it's just a little 2% sliver. But yeah, to answer your question, you are absolutely right. On a single day or even a week, CAOS is fairly unimpressive. But when you put it into the context of it's better than losing money, and if it can make a little bit as well, now you're golden. You protect your capital during the crash, hopefully get back in shortly after, and that's when you can really accelerate your portfolio, right? as they say, everybody's a genius in a bull market. It's not overly difficult to do well if stocks are just rocketing higher. What the vast majority of investors have no idea what to do is how to protect their capital when the market goes down. They just kind of watch it in horror, and that's not my strategy. I've probably made far more money over the last 20 years protecting capital in bad times than I have, outperforming the market in good times. That's not, it's nice, and that's why we use leverage. That's why we do short vol. Of course, we outperform the market most of the time when it's doing well. But we really outperform the market when it crashes. That's the key. And CAOS serves its purpose there for sure. So it's not for everybody, but don't write it off. At least run some numbers. You might be surprised. Why does the Bitcoin strategy use IBIT? Other ETFs have lower fees. So the reason that I chose IBIT, look at me, I'm just plugging my website all over the place today, aren't I? Bitcoin. But I would encourage people to bookmark my website because I'm a workaholic and I've got 1,000 articles, and I've got so many articles I haven't even uploaded them on the website. I can't be bothered. There's just too many. So where's the Bitcoin breakpoint? I did a comparison between the three, and you've got to choose one, right? So as far as fees go, IBIT, GBTC, they're both fine. They both kind of do their thing. The only reason that the GBTC did a little worse was it was just one single period where, it didn't track very well. But otherwise, wait a second. Have I got these colors mixed up? Anyway, this might actually be wrong. That's a good catch. I'll have to update this tomorrow. But the IBIT is slightly better, but I agree with you that, fees-wise, just go with what you feel tracks Bitcoin very well, right? Of course, that's most important. Don't use something like BITX or something, the one that uses the futures. I don't know why that thing has so much capital, to be honest, but there are some that are not even remotely close to Bitcoin's performance. But IBIT is, I'm not going to say dead on accurate, but it's as close as you're going to get. Obviously, the best choice would just be Bitcoin. If you have your money structured in such a way that you can buy and sell it, quickly on a day period, and you don't mind doing that, cycling sort of in and out, it only trades maybe twice per month on average. It's not like you're doing this every day. But yeah, Bitcoin's primary number one, and then the ETFs. There are a couple of them that perform really well. So I like IBIT. It's so easy. I do everything through Thinkorswim. And so, I don't want to go do the Bitcoin thing somewhere else. I held the two coins, and I had the goal of actually actively trading them. And even for me as an active trader, I got a little bit annoyed with it. So I actually kind of just like the IBIT. And people will probably, true Bitcoin faithful people will probably be angry about that. It's kind of like the gold bugs getting mad when you use GLD or IAU. They'll say, oh, you're using the paper money. It's not the real thing. Okay, but I'm not planning to hold it for very long. I'm in and out. It's a tactical strategy. The ETFs work just fine for me. Lately, Bitcoin has decoupled from the Nasdaq and is trading similar to gold. Will that change the strategy? No, nothing short-term will, but of course I pay attention to these types of things and I track everything. And if we go through multiple market periods where it does seem like the exposure has changed, then I will change with it, right? I am not married to any of these strategy rules. I can change them if they need to be changed. I think right now, Bitcoin's done extremely well. Maybe it's just cooling off a little bit. It does feel, and this is just a random thing. It means nothing. I have no data to support it, but it feels like the crypto craze, at least recently, has kind of worn off. I'm not saying it's never going to come back. It probably will with a vengeance at some point, but I don't see the usual crypto news cycle that I used to see. It's really, recently it's definitely the tech stuff, the AI stuff. That's where the action is. Crypto, I'm not saying it's gone or anything, but it's a little bit muted. People's excitement, videos, people making, all the influencers talking about it, it's less, right? It's less these days. And like I said, it's becoming more mainstream. We've got banks all over the place opening ETFs. That's going to change how it trades. That's going to make it trade more like an institutional product. So all of these Bitcoin people who love it because it's rocketing up 100% a year, and they think, oh, this is incredible. The JP Morgan's doing it. All these banks are doing it. Goldman's involved. This is incredible. Kind of not really, right? You don't want it to start trading like a standard run-of-the-mill institutional product. That's probably not what you're looking for. But okay. Here we go. Oh, okay. I missed one. I can see it in the corner of my eye, and it's a good one. So I'll have to circle back. I don't know why the feed jumped on me, and I did this one. VTS Options Academy is coming along. It is coming along. I'm making progress for sure. The VIX option strategy is pretty much done. I think there's about 25 videos there. The introduction is done. There's about 20 there. And then I've basically just got to fill in a couple more strategies and we can launch. I'm not going to do it's just I don't have all the time in the world to work on it. So I'm just going to have to launch with 2 or 3 strategies. And then the plan is every 2 or 3 months, I will behind the scenes, as everybody's learning the main 2 or 3 that I launch with, then I can fill in another one and we can learn that one. And then maybe 4 months later, behind the scenes, I'll build out another one and we'll launch that one. I've got several, but if I stretch this out too far and I want to be too much of a perfectionist here, it's just never going to happen because I do have, I guess, what you'd consider multiple full-time jobs. So, but it's making progress. Okay, so Sean has a couple of them. First, you asked about the Bitcoin, and then for some reason the feed skipped, but you had 2 more. So what do you think of Gane poking the champ's eyes out? Do you agree with Ariel's suggestion that a foul is a foul regardless of intent? So, yeah, I'm sure nobody cares about our UFC talk, but Cyril Gane recently fought Tom Aspinall, and he was doing great. 4.5 minutes into the first round, Gane was dancing around, bloodied him up. It was impressive because John Jones starched Gane in about, I think about 80 seconds, made him look pretty stupid. And this one was going his way for sure. And then just both knuckles, one of them knuckle deep. It was a bad eye poke and it was over. Heavyweight title ends in a no contest. So it was crazy. To me, it was clearly unintentional, right? Some fighters just fight with their hands out like that. It is unintentional. Do I agree with Ariel's suggestion that a foul is a foul? I do. I think that, intent doesn't matter, right? I mean, I just can't think of any other sports really where what you intended to happen and what actually happened in the real world matters at all. Let's say a basketball player he travels, 4 or 5 steps, but he turns to the ref and says, "No, you don't understand. I was off balance. I couldn't dribble and, take 4 steps like that. It's just, I didn't intend to travel. Trust me." The trust me, bro, doesn't work. You did travel, right? In hockey, did you cross-check somebody? Maybe you didn't mean to, hurt them or get the stick up too high. It doesn't matter. What actually happened? Is it against the rules? Yes or no? Is it a penalty? Yes or no? This idea in the UFC that a foul is only a foul if the referee feels in his gut that it was intentional is ludicrous. Is a poke in the eye illegal? Yes. Was a poke in the eye actually in the fight? Yes. Do we care that he intended to do it or not? Which I don't think he did. No, I don't care. Point taken. That's it. It's a foul. You had your fingers in the other guy's eye. They're not supposed to be there. So, yeah, that's my opinion. And I can't wait for the rematch because while I think Aspinall got lucky, I think he actually saw Cyril Gane as a much more formidable opponent. And I think he's going to change his game plan for the next fight. And he's probably going to end up winning. I mean, of course, it was only 1 round. We have no idea what would have happened. But Gane was looking good and Tom was rattled. And Gane won the first round. But I think if they rematch, I think it's going to be, I think Aspinall's going to, luckily, I think he's going to get it on the next one. So have you looked into the new 5 times ETFs? Yeah, this is ludicrous. I posted recently, that's a top. I think it's volatility shares. They're coming out with a whole string. Hopefully they've filed. They're trying to get them. Hopefully they don't actually come to the light. But 5 times, who's that for? Who's that for? And I've noticed that Volatility Shares has, they have a few things that you do ask the question, like, who is this for, really? I know who it's for. It's for them to make money, and they're running a business, so good for them. They've got some that are doing fantastic. They've got others that don't. Great. No problem with people running a business, but 5 times ETFs, really? I was just talking about how even for me, somebody with a 15-year track record of great success, even I don't trade the triple leveraged. What, I'm going to trade 5 times leverage? You want to tell me that the people launching that have an actual track record better than mine? They don't, I'll tell you that. Very few asset managers out there could say that. But even for me, I don't go past 2 times leverage. Who is this for? It's so absurdly reckless that it should be illegal, right? The regulators should just absolutely full stop say no matter what. Now, will they do that? Probably not. At some point, we're going to see a 4 times and a 5 times, and it's just going to get worse and worse. Hopefully, people are smart enough to know that you can't possibly control the risk on something that moves that quickly. It is impossible. Don't care how good you think you are, how awesome your crystal ball is. At some point, it's going to go badly, and when it does, you're 5 times leveraged badly. So enjoy. I will be steering clear for sure. Obsessed with sneakers and hats. What else for curiosity? Well, sneakers. I'm a runner, so I mean, this isn't even close to the shoes that I've got. But yeah, I'm a runner, so there's always 4 or 5 shoes every year that you just kind of have to try. You don't have to try. It's very rare that something comes out that's truly exceptional. Recently, the Asics Mega Blast, I mean, greatest shoe ever made, but it's rare that something does, but I'm still kind of, just to keep me interested, I do that. And then, of course, I am a former professional golfer, so I occasionally get out to the golf course still. And of course, you need a different color hat to match your outfit. I mean, obviously, everybody knows that. So I've got every color of hat as well. What else? Not a whole lot else. I mean, aside from what you see in this room, I'm an extreme minimalist. I really don't own anything. I don't have any stuff. Everything I own is in this room, basically. I've said this many times. I've taken pictures when I traveled. Everything I own fits in 2 suitcases. I can just up and leave anytime I want, and whatever small things I left behind, burn it. I don't need it. Yeah, I'm an extreme minimalist minus I love running shoes, and I've got a lot of golf hats. Okay. Regarding triple versus double Nasdaq, but you will get better result when leverage will be 2.4. Just back test it. Yeah, that's funny. There is it's kind of tongue in cheek, but of course there is always an optimized level, right? It's not 2, right? We currently use the 2 times Nasdaq. What would I use? I mean, when I had a 40% drawdown in that strategy, I just woke up the next day and kept trading it. So it's no big deal for me. I can tell you, as a person who also runs a business that has many people in a community, we had people pull the plug, right? We had some very angry people. Not that many, fortunately, because I've done so well that it kind of masked over it. But the truth is, there was one guy in particular that I just felt so bad for because, I mean, he couldn't have gotten burned anymore. Let me just show what happened. This is just unfortunate luck for this poor guy. And he probably wasn't alone. But looking at this chart of performance, right? You can imagine that given the fact that I run a business, we do get new subscribers trying the free trial and joining the community every single month, right? There's never a month where there's not at least 10 or 15 people, usually more than that are joining the service. And there's really never a month that people aren't leaving. It's, I'm not going to say it's a revolving door. We've got a net positive, and it's just the community has grown over time with the performance and the videos and everything I do. But you have to imagine that there were 15 people joining right at the peak. And then what happens, right? It crashes down. I'm kind of laughing, but I shouldn't laugh. The truth is, if somebody joined at the peak and then had that 40% drawdown, they will think with utter confidence that I am an absolute fraud, right? I've been posting performance, talking about how great the strategies work. And this person's like, okay, I'll finally join the community. And look what happened to him. And probably more than just him, but he was the most vocal. And I do feel terrible. He's long gone, unfortunately, because we did recover very quickly and, push to all-time highs. He did not. But anyway, I don't know where I was going with that. Yeah, I totally lost my train of thought. I just thought that was funny, worth mentioning. But you can imagine that if people join, at a low and then we do extremely well, like if anybody who joined early on this year, say you joined in, March or April, given how awesome everything has gone the last 4 months, people probably think I'm just this genius trader. If you join at a peak and then it's an immediate drawdown, you think, oh, this guy's a fraud. It's the same strategies. It's the same signal, same guy, same YouTube, same everything, but wildly different experiences depending on when people join. And that's an unfortunate reality of investing. It's not specific to me. This is absolutely everything. You might finally get yourself a financial advisor, and wouldn't you know it, he immediately crashes your account, right? It can happen. I know I was going somewhere with that point. Let me just try to think about this. I was talking about how there is an optimized number, and it's probably not 2. What would I do? Oh, yeah, I was saying I held on. I woke up the next morning and was just fine. What I would say is for community members, probably somewhere around 1.7, 1.6. I don't think anybody would ever leave if it was at that. But unfortunately, when you try to push it to 2 times, and absolutely if you pushed it to 3, even though I know where the strategy is going in the future, it's not going to mean anything to somebody else. I'll say, trust me, bro, it's gonna recover. You'll be fine. Nope. When you're in the bottom of a drawdown, there's no rationality at all. It's just, it is what it is. So, 2.4, nah, it's probably 1.7. Okay. Looks like 6% increase. I think this is the triple Qs. ROA for a 9% drawdown. Yeah, I mean, the ratio is never going to be exact, and it's going to scale itself out. If I showed the same thing for a 5 times ETF, like these people are trying to get launched, that would be something. Like the benefit would be tiny, the drawdown would be insane. It wouldn't be worth it. Okay, at Alfonso. I probably missed something. Yeah. Recommendations for other safety stuff, maybe. Oh no, ARK. No, stay away from ARK. Don't. I mean, that's a blanket statement, but I've had my history with bashing the ARK innovation stuff. Okay. Last question. We did it. If you mention GLD to some gold people, they want to fight. It is absolutely true. I've noticed that over time as well, that that's when you kind of know that you're dealing with an asset class it's a little bit more than an asset class, right? It's like a way of life for some people. It's like a little niche community where they feel like they're kind of the only ones that know the truth about the world, right? They know the truth about the financial systems, and we do the gold thing, and it has to be physical gold, and you're a clown if you're using the paper products because those are pumped by the banks and all the things that you hear. It's just an asset class, Same with crypto. I can respect somebody who says I only buy and sell Bitcoin itself. Okay. I have been trading for 20 years. I've never seen anything in the trading world that makes me think that the financial system is about to crumble and you should avoid holding ETFs. I've never experienced that. I've never experienced it in even a fraction in gold or in Bitcoin. Sure, if the world changes and I start to notice some major cracks under the surface, like I wouldn't want to be holding GLD right now, well, then I'll change. But as of now, I mean, it's just, why would you hold physical gold when the GLD is so perfectly tracking the day-to-day results? It just, whatever, to each their own. All right. We will wrap it up there. Like I said, more content coming. I've got to dig myself out of this hole. Fortunately, that tooth couldn't have come at a worse time. But I'm pretty again, so we're back. I will see you guys next week.